As my background is in finance and investing, I will be speaking about achieving high returns in the crypto world, in the new financial world, where my job is to apply findings and methods and tools from the old financial world to the new one. And the new one is, of course, the crypto world. So my background is in investing. I'm a quantitative manager of a small fund, and in the past 10 years I've been developing different tools, different strategies, and so on regarding just how to achieve additional return with the same amount of risk. So the whole point of this short talk is about achieving that optimum amount of return per a given amount of risk, and I will define what risk really means. And I'm not talking about losing your private key, which is probably the way more important risk here compared to the old financial world. So as we heard also before, cryptocurrency can be looked at as a new asset class. But tokens themselves can be viewed also as utility tokens, but they can also represent anything else. They can represent stocks, they can represent bonds, they can represent real estates, and so on. And this is a really a new thing in the financial world, because now almost everybody is able to invest also in startups and so on. So basically, crypto world is democratizing investing and trading, which is a really nice feature that we got from the Ethereum smart contracts and the ICO phenomena. So if you want to be a successful investor or trader, you should basically not focus on finding the best investment, but you should probably be like amateur tennis player. So anybody who plays tennis and is not like Federer, Nadal, or anybody else probably wins the matches by not doing the mistakes. So it is the same in investing, and especially in investing in the crypto markets, because if you avoid the losers, the winners will take care of themselves. And that's a really important thing in not only investing in ordinary markets in the old financial world, but especially here in the crypto financial markets. So one way of doing this by avoiding mistakes is, like we heard before, it's investing in individual ICOs. But the point here is, because you cannot never know which project will return like Ethereum-like investments, returns, you should diversify. So basically you should invest in more than just 1 or 5 or 10 ICOs if you want to play this like a professional who tries to achieve really high returns in the end. If you look at, let's say, in the old financial world, the best angel investors, the best venture capitalists, they all have like hundreds of investments, and only a couple of them pay out spectacularly. And that few of them take care of all the returns. So this is one way of investing, let's call it angel or VC investing, which is really easily applied here in the crypto world, because anybody can now be an angel investor. Just invest in ICO and you can call yourself an angel investor. But you should definitely do your due diligence here, and co-founded is doing a really great job here in Slovenia and around the world, making the first list of which basically projects are okay and which are not, because if you do not go through their filters, then you are not a really good project. So because they're really selective, and this is a one way to avoid the losers. And the other side of, let's call it long-term investing, is more of a passive investments. So we all know like S&P 500 is an index fund, is an index that represents 500 of the largest US companies. And if you buy just that one index, you are exposed to the whole US equity market. So the whole point there is, because all the assets, all the stocks are not highly correlated between themselves, you get a diversification benefit. And that's the whole point of being a passive investor who can basically hold to his investments for the long term and watch the relative volatility, but to be able to achieve like really high returns here in the passive investment style of investing, you should definitely pick something better just compared to like market cap weighting, which means that you buy just top 5 or top 10 of the largest cryptocurrencies, if we're talking about the crypto. So I'll be presenting here a passive investment strategy that is called risk parity. It is a special kind of a strategy because it puts the weights on individual cryptocurrencies based on their risk. So risk is here defined as volatility. So basically how fast the cryptocurrency moves around in every single day. So if it's really risky, then it jumps around a lot, as we've seen like every cryptocurrency currently does that like really a lot. But the whole point is you want to have an equal exposure to the risks. You do not assume anything about the future returns. You are like just assuming I want to have exposure to the whole market, basically equalizing the risk between every cryptocurrency that you select. So you can do this with risk parity. And here we can see the correlations between the individual cryptocurrency. These are the top 5 in the past 1 year. And you can see that, let's say, correlation between Bitcoin and between Ethereum, between Ether, is about 40%. Which is great if you try to diversify, because if you buy both of them, you get some diversification benefit, which means that when one goes up, the others might lag or go down. So basically, one almost cancel each other out. The lower the correlation, the better the diversification benefit. So this is an important thing. And if you only look at the top 5, we can see that you can achieve quite significant diversification benefit because of this low correlation. So the risk parity strategy is just a strategy that optimizes for the volatility. It's calculated really simply. I will not even go through it. If someone wants to know, just ask me. And the whole point here is, as we can see in this chart, which shows us the returns in the past year, we can see that Ethereum was the best investment. If you invested like 100 euros, you would now have 7,000 euros, which is quite of a return for 1 year. But the whole point here is the green line. So this green line represents the strategy itself. It is the risk parity crypto index that we are calculating. And the whole point here is that you see it has the second best return. But that's not the whole point. The whole point is that it's not as volatile as other. It does not jump around as much as others do. And this is seen here. The whole volatility things means how much do assets jump around. And you can see, let's say in the example of Bitcoin, the volatility is about 80% on an annual basis. If you compare that to, let's say, Apple stock or some other average stock on the US market, that volatility is about 20%. So you can see that already the Bitcoin is really volatile, and if you take then Ether is even more volatile. And if you look at the risk parity index, it's closely related or somewhat volatile as Bitcoin. And here are the drawdowns. Basically, how much do these cryptocurrencies did lose in the value? We can see that losses from the recent highest value to the recent lowest value can be quite significant, at least 40%, in some cases to 60% or even more. And this is one major source of risk, and we should definitely try to avoid this. And by doing some simple diversification using, let's say, this risk parity index, this strategy, you can see that you reduce your drawdowns quite a lot. So you see that the drawdown is about 45%, which is compared to Ethereum, which is about 65%. So it's a quite nice reduction that comes from the diversification benefit. And the whole point of using this strategy is to achieve highest return for one unit of risk. So if one unit of risk is volatility of the cryptocurrency or even any other asset, the whole point here is that using such strategies, you can achieve really good returns compared to the risk you're taking. So this is only one of the possible strategy, but is one of the best because you equalize the sources of the risk, and then returns follow every individual cryptocurrency's risk attribution to the portfolio. So we are building so-called CTIs, crypto trade indices, on top of these indices, and the whole point of them is they're ETF-like tokenized funds, which means that you can get the exposure to the underlying assets inside the index with only one transaction. So this is the whole point of using these passive investments, so that you can easily get the whole returns of the whole market and not basically buying every single cryptocurrencies. And they will be offered in the first quarter of 2018. And this is how the whole system works. We have a couple of smart contracts that take care of issuance and redemptions for the funds. When the investors send, let's say, 100 Ether, they get back the CTI tokens, which represent the underlying index and the underlying cryptocurrencies. And then we have a couple of market makers where their job is to buy every cryptocurrency that is in the index and then deposit it in a wallet. And that wallet is fully transparent. Of course, it is with a custodian, and nobody can access to it. So the whole point here is that we also use a hedge token as a collateral, so the market makers are incentivized to be fair, to be not to steal the money, because if they do, their collateral is then taken from them, which means that they lose more than they try to steal. And so this is the whole structure, and these CTI tokens can then be traded basically on any exchange. So with a single transaction, you can get the exposure to, let's say, to 10, 15, 30, or even more cryptocurrencies, and you can be a passive investor for the long run without the need for buying every single one of them. So if you have any questions, you can just shoot me an email or ask me outside, and I'll be glad to answer them. Thanks.